I am hearing this objection pretty often, being in the real estate profession, that some buyers are waiting for the home prices to go down, or I'm hearing objections as well, and fear and trepidation as well, that 2022 is going to be a repeat of 2008 real estate market and the economy. Hi, everyone. My name is Bobby Taruc with Team Taruc, Keller Williams Premier Properties out of Glen Ellen. Thank you so much to my guests. We'll go round robin here. Marcus, if you don't mind introducing yourself, thank you for joining.
Sure. Yeah, Marcus Rember of the Rember Blount Property Group in the Plainfield, Naperville area. So, topic that, as you said, Bobby, it seems to come up repeatedly.
Absolutely. Bill?
Yeah, my name is Bill Penley with Caliber Home Loans, and been in the business for 26 years. So I was in that nice little world that we lived in 2005 to 2008. In fact, I bought a property in 2005. So there you go. So I got some scars from that, but I love getting in a group like this with people that are in the industry, front lines, know exactly what's going on street level to really talk about this. Just from our perspective, because obviously the media has a different interpretation many times. And I just want to make sure that we're all on the same page, because I feel like people are getting the wrong impression of what the market's doing.
Absolutely. We bought this home that we currently live in as well in Warrenville. We purchased this in 2005, and I feel that we bought at the height of the market as well. So anyway, that's besides the point. Marcus, your team does a whole lot. You have had a busy July, and I would imagine August is turning out to be the same for you. Oh, for our team, we're kind of heavy on the buy side for some reason this time around. What are you hearing from your clients? Let's talk about it.
Yeah. So I want to start by saying Bill made a great point, because I think one of the things as realtors we don't do good enough job of is empathizing with our clients. And what I mean by that is Bill said he bought in '05, but I bought at the same time, bought at the height of the market, and
Right.
had to go through that time frame. So I share that story with our clients a lot who are on the fence. So what I'm hearing from them is just that, hey, I don't want to buy. I'm going to wait for the market to crash. And so just educating them on, hey, okay, well, why do you think the market's going to crash? That's always where I start with that question. I want to really, while we can all say we can assume why they think that, because looking back at '08, I want to totally hear out their perspective on it. To first make sure that, it's important that our clients feel heard.
Mm-hmm.
And also to better handle their objection once we hear that. So what I'm asking them is like, hey, okay, well, what do you think is similar about this market as 2007, 8, 09? And so it usually goes to prices. And so then what I do is say, okay, well, do you know what the driver is behind prices right now? And then the other thing, just to give them some perspective, I will also compare our national real estate market to other countries. Because if you were to look at a chart of real estate markets globally, the US real estate market is probably still one of the most affordable on the globe in terms of, top tier countries. Canada's real estate market is, valued higher than ours. That, they've been dealing with this for years in Canada. You go to Europe, you look at the cost of real estate here compared to certain parts of Europe, Paris, UK. Our real estate is still, relatively speaking, a bargain. It's just that from our perspective, it feels very expensive. And that's not to be insensitive to anybody's budget, but just to give them some perspective on that.
Yeah, absolutely. I always want to hear from the lender side because, of course, they play an integral part of this entire ecosystem. So, Bill, share with us as well, what are the fears out there from a buyer perspective?
Yeah, that's I just kind of go off the last situation ahead. People are still like the rates changed significantly since December, right? So what you're seeing is a little bit of payment shock with people. So with that being said, you get a little bit of a reaction, a little heart beating, racing that you hear coming from the client's perspective. And like Marcus said, you got to be able to listen to what their concerns and fears are. And if you can like hear them out, listen to it, and go, okay, look, I completely understand where you're coming from. But if you look at the history of where rates are, they're not too bad, and really kind of just play that psychological response there and let them know it's not as bad as you think. It's bad when it reacts like this, when you see the market reacting. And this becomes very scary for a lot of people. So it's our job on the front lines to really provide that comfort. So what I try to do is I try to get in front of people. I think that's a very valuable thing to do nowadays and really explore different options. Like perfect example is the client that I just met with. They didn't know where they wanted to be as far as monthly payment. They didn't know where they wanted to be as far as house payment. But so I just kind of ran a couple different scenarios. And when I watched them kind of get pushed back by the numbers, like, okay, let's adjust it down a little bit. Where does this feel? Do you feel comfortable at 1,900 versus 2,200? Yes. Okay, perfect. That's where your rent price is right now. Your rent's going to continue to go up. So if you feel good there, let's start there. And then that's a little bit easier for them to kind of, adjust to versus just throwing rates out that were about 4% higher than where they were, a year ago. It's just one of those things where you just got to kind of walk through it together. And like Marcus said, just listen to what their concerns are, listen to their fears, and really respond well to them, and walk through it.
Yep, absolutely. So the message I got in there, and that was really key, and thank you for sharing, Bill, was that data and information are our friends. So when we do have the data, and when we start off obviously with information, and it becomes data, and it becomes actionable data, those are what can allay people's misconceptions. So Marcus, last week there's question was obviously raised, and this is really the genesis of the idea of this conversation, was that Beth actually answered and really clear answers on how those fears can be tempered and answered. And then I also got some information. I'm not sure if you were fully aware. I listened to a whole lot with MBS Highway. His name is Barry Habib. He's a very bright person, and the team that he has around him, around that portal. So some of this information, or at least the structure and the framework of these talking points and answers, are not really my own. It's from Beth Gary and Barry Habib. But in our mind, Marcus, we as real estate professionals, we always have this in our mind, but we haven't. This is the opportune time that I actually dug deep into the data. So is that making sense?
Yeah, no, that makes perfect sense.
Yeah, and Marcus, please do chime in here, because this is very data centric, and of course, people will die of boredom. But we have this in our conversations as well. So number one is housing starts versus household formation. And now how Barry describes this is that we see this very real in our everyday conversations. We have, as an example, mom and dad, and then they have a younger millennial living in the basement, having already a high paying job. They're done with their MBA. And as junior makes a decision to actually move out of mom and dad's basement, because again, they're done with their MBA, with their master's, they have a really great paying job in downtown Chicago, as an example. Now that actually is a household formation. And in this concept right here, they're an owner occupier of that home. And junior, again, is making the decision to move out. If you look at this graph right here, the red is single housing starts. Now, please don't ask me the question, is this building permits? Or are these out fully breaking ground? Or are these occupancy permits already of new construction? So I don't have that information. You'll have to forgive me. But Marcus, take a look at this between '05 all the way to a projection all the way to 2023. you'll see that the housing starts actually got overtaken by owner occupiers and household formation. Marcus, give me your thoughts around this. This, to me, this explains the housing gap or inventory gap.
Yeah, I agree totally. I think one of the things you mentioned before, one of our colleagues, Beth Gary, mentioned in a recent mastermind we had,
Right.
which is so true. If you look at a chart from '07, '09 that showed you the housing inventory, because this last run up on home prices has been driven by two things: lack of it, well, multiple things, I should say, not just
Right.
lack of inventory, buyer demand, and low interest rates. Well, the Fed has been trying to take care of the low interest rate driver over the last 3 to 6 months by raising rates. However, if you look at a chart where from '07 to '09, where housing starts from builders, there was a builders just basically stopped building during that Great Recession of '08, '09. Because, and rightfully so, because housing was one of the primary, or lending around housing was one of the primary drivers of why that market bottomed out, which, coming back to what we were talking about earlier, is why a lot of buyers are scared here. However, once that builders stop building, now we are behind on inventory. So now if you drew a chart and said, hey, what if we would have just continued to climb at a normal rate from '08, '09 all the way to now, it would almost be a perfect chart line going up, where we would be now is where we should be if we didn't have that huge bottoming out during the Great Recession. However, I get it, because it feels unnatural to a lot of people because of how just on fire the market's been over the last 2.5 years. However, what we have to keep in mind too, and it's easy to forget this when we've been in this very acute seller's market, is that buyers always set the market in any industry. Whether we're talking about housing, the stock market, whatever, buyers set the market, and buyers have been driving. Buyers like, hey, there's not enough inventory. Money's been cheap to borrow. I'm gonna pay you over list price because it's really not impacting my monthly payment. Now, having said all of that, loans have been harder to get since the Great Recession, which Bill can go into way better than you or I can about it. Loans have been harder to get, and that really was the impetus, the driver for the last market. That the guidelines around lending were pretty non-existent back in the run up to the Great Recession. So,
yeah, absolutely, yeah, great point.
Yeah, it's funny. It's funny you should bring that up, because I literally, before we met, I was writing down a couple of different notes, and I put other issues, and one of them was building is not what it used to be. So you answered that one, and the inventory is the issue. And when you couple that with the birth rate of millennials that are buying, you have a perfect storm scenario with regards to demand, even if rates do go up. And now we're also seeing that on the rent side as well too. Look at people's rents. Anytime I get on a phone call with somebody, I always ask them what their rent is. We've saved people thousands of dollars, even with their increase on interest rates. We've actually helped people keep homes because their rent went up about $500 or $600. I had this happen down in Florida. I'm licensed in Florida, and a lady was trying to retire down there. She had a small little apartment, and her landlord came up to her and said, yeah, I know I'm charging you $1,700, but we're going to increase it to $2,500. So she talks to her financial advisor, and her financial advisor says, listen, you could get a mortgage for much less, same square footage. We were able to get her into a small little condo over there for $1,200 a month. So she was just ecstatic. And that was when rates were a little better than they are now. But at the same time, even if they go up 0.5%, still a better option for you as far as that difference goes.
Yeah.
You know what, buddy? I'm sorry. I'm just jump in.
Go ahead.
Something Bill just said, I actually dealt with this exact situation today. So it's amazing to me And I get it because I think for buyers, buying something feels way more like a commitment and a long-term commitment than renting. But people are willing to rent for more than what they purchase for a monthly payment than what their purchase is. So I had a buyer today or someone I've been working with, they're pretty conservative in their approach to getting something there, and they're a school teacher. So I get that. However, she's been scared to jump into this market. Well, she just signed a lease, and she signed a lease for $700 per month more than what she told me her comfort zone was for a mortgage payment.
Okay.
Exactly. So I text her, I say, so you're comfortable with that payment? And she said, no. She said, hey, she used an expletive and said no. But she said, hey, I just wanted to secure a home. Well, we know that I said, hey, we have to talk, because shame on me as her realtor to not have gotten out in front of that fear and helped her to, educated her properly so that she felt more confident in committing to purchasing. Because now if you extract that out or project that out over a year, she's going to be $7,000 more, more than that, because 700 times 12 is about $8,400. $8,400 more for renting something that she's not going to get any financial benefit from, versus if we found her a place at her max budget.
Yeah,
absolutely. John Robinson had the exact same example and scenario this past Wednesday. I'm sorry, Bill. Were you going to say something, Bill? I'm sorry.
No, I was just responding. Wow, that's wild to know that, and it goes back to what we were talking about before. Not only is the consumer reactionary, but I'm also seeing that the feds were very reactionary. Even when we got in the early pandemic, I'm sitting at a restaurant on Sunday night, and this is when they decided to drop rates through the floor. And I had about 15 different text messages that were like, "Oh, rates are going screaming low!" This is the problem. They put too much money in the mortgage-backed securities. So there, you got two things that are going on right now. You got the fact that they put too much money into the mortgage-backed securities. Now they're trying to refill their balance sheet. So you have the feds that are increasing the Fed fund rate, which is trying to drive down the cost of goods by reducing the demand. The feds are designed for, to increase or reduce demand, right? So you got the Fed fund rate. That's one piece. But then the mortgage-backed securities is the other piece, where they're trying to replenish their balance sheets. So when you have those two things going hand in hand, there's just a lot of confusion, a lot of smoking mirrors that are going on with regards to trusting what's going on behind the scenes, and it's scary. So it's kind of like anything else, like a war. We're in the front lines. We're seeing this. The news can't understand it because they don't know. Like, they're trying to listen to what they're hearing from the feds, which the feds don't really have a good track record anyways. So when you're looking at it from a market standpoint on a Main Street level, we're seeing this communication. That you made a great point of listening to the consumer, finding out what their fear is, and adapting to that, and really kind of counseling them through it. So it's just one of those things where, like what we're doing right now, we need to come together as professionals that know exactly what's going on Main Street level to really counsel these people. And so what I've been doing too is I've been taking it to a buyer consultation with both the real estate agent and myself to really help them look at the numbers. Because when you visually can see it, you see an aura kind of take precedence there, and the people decide to go, okay, that is it. I can relate to that. I can understand that. So I think a lot of people are missing that from the lending standpoint. So it's one of those things where I'm trying to let people know this is what I'm doing. That's helping people understand and feel comfortable there.
Yep, absolutely. Well, so much to talk about. Of course, there's a lot of real life conversations here. But I wanted to go back. Bill, you mentioned the feds, number one, and you were talking about lending as well. Let's talk about really quick. I know this will be your wheelhouse. Let's talk really quick about the changes out of post 2008. So you are very familiar with these. So I'm not going to read them verbatim, but from your perspective, just real life examples pre 2008, and of course post maybe 2010 or 2009 lending practices.
Mm-hmm. Yeah, that's funny because the notes I had after Marcus are down here and these are up here. So going backwards a little bit here. But yeah, the first thing I mentioned or that I wrote down was lending requirements. So lending is one of those things, like Marcus mentioned, was so loosey goosey. It was so crazy. I was just brand new in the industry, and people were coming in. Oh yeah, you know what a NIA is? No income, no asset verification. Do you know what a stated loan is? Yeah, you can just basically put down $100,000 for that janitor, and he could get into a house. And it was
What's your DTI? 100% DTI?
Doesn't matter.
Yeah.
I had one person didn't have a job that she had 5% down, didn't have a job. It was basically a complete no doc loan. So all she really needed to do is breathe fog in a window, and she got into a house. And that was right before the shift. I only did maybe one or two of those. And that was the one I did where she was this is weird. She was trying to buy places at the same time, didn't tell anybody else. So she must have watched a HGTV or like late night infomercial to try to buy these properties. She quit her job and took $100,000 trying to buy all these properties, and it sent her off the deep end. So we were a paper. My brother owned our company for 20 years. We were a paper lender. Never wanted to touch those, but in this particular case, I asked the agent at the time. I said, "Is she legitimate? Because I don't want to put her in a situation." And she goes, "Oh yeah, she's got backing. She's got like 10, 15 people that are going to be her partners." I'm like, "Okay, completely fine. If she's going to buy this owner occupied." Went back to refinance her, found that she had 3 properties that she's writing contracts at the same time. I'm like, "You've got to be kidding me." So that was back in the day. Now that would not happen nowadays, because you have to show income. You have to show assets. Yes, we do have an asset program, but it's not like it was before, where it was. The other problem too is you're stuck in a 2-year fixed or 2-year ARM, which after that it's going to adjust. So let's say if somebody had bankruptcy, foreclosure, they could still get into this property with a 2-year ARM. That 2 years, we all know, goes by very, very quickly. Right. And that's where the ARM's got a bad connotation or bad rap, because they would be put in these BC loans, and then all of a sudden they couldn't have enough time to fix their situation to get in a qualified state. So you had all these people just fall out. So you had that piece, the BC lending side, non-conforming lending side, that was going like crazy, like, the old Wild West. And then you also had the other piece that I think that people don't really touch on, home equity loans. I remember going to a bank a couple of times, and they never even asked me my name. They'd ask me how much I wanted for a home equity loan, because they didn't do their due diligence on the appraisals. So people were buying Harleys and putting those on their home equity lines, and before you know it, they said, "Oh yeah, your house is worth $500,000," when it was really worth about $100,000 or $400,000. If Marcus or Bobby were actually doing an analysis on that, you would know that that's way, way off. And so that's where they got away from the appraisals, and they went down the wrong road with that. So you had a lot of people that I talked to, most everybody had a home equity loan, including myself. And once that home equity loan gets stuck on there, it becomes an adjustable rate. A lot of times it's a HELOC. There was home equity loans too, but those were really, really high rates. So people got stuck into the adjustable rates on those. So you had all these different types of very, very loosey-goosey lending requirements that would get people into deals without even checking, doing their due diligence, and they got stuck,
Yeah, absolutely.
So right now, I also say that the loan to values are different too. So when we go back to the home equity line of credits, they won't go over 90% right now, which is actually good. If you get somebody that's saying 100 or even over 100,000 or 100% of the loan to value, I think that's a bad call right now for anybody. So I think that that's a good thing. They're actually a little bit harder. They used to be very easy to get done. Like I said, breathe fog on a window, you get a home equity line of credit. But now you actually have to go through more kind of scrutiny when you get a home equity loan. So, yeah. So I think we're looking really good as far as like the types of loans that are out there. I'm not seeing those BC loans come up. We're having portfolio loans, which I think you're going to see the need for some of those portfolio loans in a market like this, but they're not going to get anywhere near what they were before. It was, like I said, it was like the old Wild West. It was crazy to see what they were doing on some of these loans.
Absolutely. So Marcus, let me ask you, how is this conversation being brought up as well with your buyer clients? Because I think people have to be educated. Well, I'm old enough to remember as well what pre-2008 was like. So I'm that old. But with the younger buyers, with the millennials, they don't know what 2008 was like. They probably were born 2005. So what are those conversations like for you?
Yeah, no, that's a great question. So what I'm getting people to focus on is what we can control, right? So let's talk about your motivation. Why are you looking to, what's interesting you? What's driving you to want to purchase a home? Could it be just more space? Could it be just for investment, long-term investment purposes? No, a lot of times I hear, hey, I'm just tired of throwing money away on rent. Okay, perfect. So really at the end of the day, one, let's not worry about interest rate because we can't control that. And two, let's focus on what we can control, which is your monthly payment. And I also ask, hey, what are your biggest fears? So if you're afraid the market's going to crash, okay, let's go there. Let's say the market crashes 2 years from now. How does that change what your needs are today?
I like that. That's good.
If you need a place to live, whether the market crashes 2 years from now, next month, 5 years from now, that doesn't change what your motivation is today. And the other thing that's come up a lot is interest rates. Well, hey, interest rates are high. Well, high relative to what? Because really, Bill can answer this. It's like, how many people call you, Bill, and say, hey, I want to buy a home because interest rates are low? It might be one of the reasons, but that's not the driver. No,
right.
Or at least I don't know of anyone who woke up and looked at their significant other and say, oh, honey, interest rates are 3%. Let's buy a home.
Right.
Yeah, it may be a benefit, but the driver is typically going to be, hey, I want, we're about to start a family. Let's get into an area where we have more space, better, a school district that we like, so on and so forth. All of those things are totally separate of interest rates, which, by the way, we're still at historical lows on.
Right.
When you look at it over the last 40 plus years. And the other thing, and I'll end here, is that I tell my clients, first time buyers especially, the best way to ensure you get the very best interest rate is to lock in today if you need a place, because now you're protected. Let's say interest rates right now is somewhere in the fives. If I get them today, if interest rates go up, I'm protected. I'm locked into the best interest rate. If they go down, I'm in a position to take advantage of that. I can call someone like Bill and say, hey, I want to refinance. Right. Well, wait until interest rates if they go down, let's say interest rates drop down to threes again. What's the buyer going to be faced with at that point if they don't already own a home?
Right.
Offers higher pricing. Probably one of the big things that a lot of my buyers are complaining about over the last 2 years. So if you are in a home already and your payment's comfortable, everything else will take care of itself. Market crashes, guess what? Data shows.
You shelter.
Mm-hmm. Yeah, you shelter. You shelter in place. Data shows that over the course of 10 years, you will be fine. You hold real estate anywhere over a course of 10 years, regardless of when you bought the real estate, you're going to be protected.
Absolutely.
Right. I think the one thing that it started kind of, even though I've been doing this for so long, I had one of those meltdown moments about a month ago, and I got in a call like this. And I remember one of the guys is with our number one branch out in Kirkland, Washington. He gets on there and he's been doing this even longer than I have. He said, price is forever, mortgages are temporary. And that just clicked for me, because think about what's happening. This is the weird part about the human nature. They were looking at the diamond, right? Which is the house. They're going after it, willing to pay over price. But then when we see a market shift and you see the rates pop up to try to drive that down a little bit, so you're not having to overpay for that property, now the consumer is fearful because of the interest rate, and I think when you look at the history of inflation, so just remember, when inflation rates go up, mortgage rates follow, right? So if you look at the history, if they're going to grab that inflation rate and pull it down, recession follows. So rates should go back down. If you look at the graphs and where the recessions kind of came in, the rate should go down. So that's kind of one of those things that a great response, Mark, is because I think that that's something that a lot of people miss. They don't understand what the down the road looks like. You know, it's very deep, like Bobby brought up. Barry Beeb said this a couple of months ago. He goes, "Look, I race cars, you know, in the race car track. He goes around the track and loves it. He goes, my coach told me, he's like, put a can of Coke 10 feet in front of that. Do you think you could follow that all the way around the track?" He goes, "No, you can't look down right in front of you. You have to look up to hit the turn and make sure you're hitting the turn properly." And that's a lot like the market. You have to look up to see what's going on down the road. And that's why I'm stressing the fact that the inflation's so high. And when that comes down, mortgage rates go up. When that comes down, rates will follow. So like you said, I'm a big fan of locking in right away. And then also when they do lock, they do have typically a renegotiation policy. Lenders do, just because back in 2008, there was so much volatility that lenders, once they lock a loan, they're going to lose that money if they don't carry through. So what you'll see is a lot of opportunities that could possibly come down the road. Not to mention what I do for a lot of clients is I'll do a no-cost refinance. So I'm promising that we'll look at that option of a no-cost refinance in 4 or 5 months if we see an opportunity to do so. Because I do feel like we'll see the rates drop. To what degree, we don't know. Because like I said, the mortgage-backed securities are pulling back a little bit on that. But at the same time, I think there's still going to be an opportunity. I'm just trusting like the Barry Beebs out there saying, look, this is what the history shows, and we're going to kind of ride with it.
Yep, absolutely. So, Bill, I may call you to do a refi on the property in Florida. So please answer my phone. My phone call. So I want to segue or switching gears here to home equity. I do remember early 2000, I was starting to work in IT. I got jealous about people taking out HELOCs to purchase Yahoo stocks. And I think, I hope people are not doing that nowadays to purchase Tesla stocks. But take a look at the home equity in 2008. I'm sharing my screen. Hopefully you can see it. Take a look at the portion of buyers with super prime FICO scores of 720 or above. 75%, huge portion versus only 25% in 2008. Take a look at the household debt or versus disposable income. In our terms, it's DTI, debt to income ratio. Fallen roughly 30% versus highs of 70 to 100% in 2008. And then I'll just go down to the bottom here. Average home equity gain between Q1 2021 all the way to Q1 2022, $64,000 average, national average. So every single homeowner year over year up to Q1 of this year just became richer, 64 grand. Now tell me this is not an argument for home ownership.
Agree. You know what this reminds me of, Bobby, is I've always had, like, as long as I can remember my corporate life, 401k, but I really didn't understand what I was investing in. I just knew, okay, get a 401k. It's a great investment. Long-term, it'll pay off. Well, in the last few years, I've gotten more educated. So you brought up Yahoo stock, which, hey, if someone owned that today, they're pretty much, to zero. Tesla stock, well, I have a better understanding of the stock market. One of the things I love about it is it helps to, if you approach it properly, it helps to train your brain. And what I mean by that is, I've been taught, Warren Buffett has this line. He said, I'm not investing in stocks. I'm investing in an ownership portion of companies that I believe in. So do I believe Apple is going to be around 10 to 15 years from now? Yes, I do. Do I believe, Coca-Cola is going to be based off its track record? It'll be around 10 to 15 years. Yes, I do. So if I believe in those products, especially if I use them, does it really matter today what the price is if I believe they're going to be around long term? And so I can easily apply that to housing. It's something can't be replaced by technology. It's not necessarily a health issue like Coca-Cola is if I overconsume it. Like I believe housing is going to be here and it's going to be needed 10 years from now. Yes. So why not? As long as the investment makes sense to my family and my budget, why wouldn't I invest in it?
Absolutely. It's finite resource. Land, obviously, we're not producing more land, and
That's right.
that makes it a very precious commodity, to your point. And shelter, again, is a very fundamental need, human need that is just like food. And it's a great industry to be in. It has its challenges. I'm not saying it's easy, but it's a great industry to be in. So this particular slide, I love this slide because Bill, you will love this slide.
Mm-hmm.
Take a look at the loan to value ratio nowadays. And this is just Q1 and Q4 to Q1. And you'll see that LTV is actually clustered around between 50 to 54%, all the way to right around 80 to 84%. So what that means is this is not an inverse of 2000. If this was 2008, it would be an inverse of this histogram.
Mm-hmm.
What this means is that people actually have a much higher equity in their home. Again, an inverse of 2008, which is really an argument of this is not a potential 2008 reprise or sequel, if you will. Bill, any thoughts on the LTVs that you're seeing?
Yeah. Back right after 2008, 2009, the minimum requirement just went quickly to like, I think we either did like FHA mortgages, like 3.5%. That was like the minimum, down to like conventional mortgages were 10% for a while. So they just put the brakes on, any of the no money down programs. We did a lot of 80/20s, which 80/20 is actually combining a loan with a second loan on top of it, like a HELOC we were talking about.
Mm-hmm.
So they got rid of those. And so you're seeing like they still have we have those back. We had a 3% down. We do have the grant programs still available. But at the same time, there's some requirements. Like for instance, we do a lot of IDA. I think we were like number one last year in Illinois. But the one thing is that they have a debt to income requirement ratio that's lower than what you'd have on certain, the other regular loan scenarios. Right. Because they're using somebody else's money. So they're putting a little bit more guidelines in there to create that that representation that, look, this is a serious thing. We're not going to just give you, money and not have you afford it, So, but at the same time, I'm seeing a lot of parents that are actually helping out too, which is pretty cool to see. I mean, you're seeing, let's say like you were talking about junior coming out of college, he doesn't have a down payment, and then the baby boomers got some equity. They'll not use their equity, but maybe they'll help them out with their down payment. I'm seeing a lot of that happen.
Yep.
So people are giving gifts, which isn't bad, but
yep. We'll probably go. I know everybody's busy. We'll probably go 10 more minutes. These are great conversations. I could talk about this for I can go another 5 hours if you ask me, but I know we have the time boxes, 10 more minutes. Marcus, this is really a very critical information around the market because, and we've experienced this as well in our business, new generation of buyers fueling the demand. There's a dichotomy between the older millennials and there's younger millennials as well. But take a look at this. The biggest share of home buyers in 2021. And then my reference on this one is Chicago Agent from March 12 of last year. 2021, biggest share of home buyers were millennials, 22 to 40 years old, 37% of all the buyers, largest share among home buyers since 2014. So they've actually been purchasing homes since 2014. Now we're just really realizing, hey, this is a large volume of generation that are home buyers, likely to be first-time home buyers. And then the younger millennials first-time home buyers in 2020, 82% of the younger millennials and 48% of older millennials, first-time home buyers. Let me park really quick on the conversation around first-time home buyers because this is a very critical piece to the sequence of events that happen for a move-up buyer to be able to actually move up either to a larger home, bigger home office, bigger yard, homeschooling for the kids. At some point in time, they started as a first time home buyer. Just like me, I started with a small condo. Then I moved into a smaller home in Lockport. Believe it or not, I live in Lockport. And then we moved here. We live in Lockport for about a year with Joan when I got married and then moved here. So, but I was a first time home buyer as well. So there's a sequence of events that happen, and it's really critical that the first time home buyer is actually a critical piece to the different phases as buyers mature. Marcus, what's this story telling you? Or maybe tell us your experience with first time home buyers, especially for the millennial generation. Big population of home buyers, first time home buyers, that is from a generational perspective.
Yeah. I think, well, first, I mean, they're a very critical piece of it because if first time buyers, they're the domino that really, helps the real estate market kind of stay in motion. So first time buyers don't have access to home ownership, then like you said, Bobby, what does that move up buyer then do? Because they can't then I won't say they can't realize, it's harder for them to realize that equity that they have in the first home they bought in order to move up into the next home, so on and so forth. And real estate is such a huge portion of this country's GDP. I've heard numbers anywhere from 20% to 1/3 of the country's GDP is
right.
Influenced by real estate. When you think of not just buying a home, but what does the homeowner do once they move into a home? They, buy furniture, paint, lawn services, things are also, this is really such a huge element of the financial success of this country as a whole. Now, here's another thing too, as you were going through these stats, Bobby, keep in mind too, with student loan, and this goes in, Bobby, you and I have experience with this, but I know for a fact Bill does. Think about the number of buyers. There's still pent up demand in the market.
Oh, absolutely.
Think about the number of buyers who are carrying such a huge load of student loan debt that they don't feel like they can buy, or it just restricts their budget so much. Those buyers aren't even in this market yet. So what would happen if that weren't a burden that we were dealt with student loan debt is higher than credit card debt? If we weren't dealing with that huge weight, what would demand in the market look like today?
Yeah, and to your point, Marcus, there are different dynamics as well to this conversation or equation. They're very highly educated. Mm-hmm. They grew up with the internet, majority of them, meaning they have information and data right at their phone. I mean, I can remember getting email on the BlackBerry. I was so ecstatic. I couldn't believe it. I was like losing my mind. But they grew up with the web. They have all their apps on their phones. They're highly educated, and they can get information and data from anywhere. So we're not going to go there, but this is the composition of the largest generational home buyer that we are dealing with and will deal with for the next few years. Mm-hmm. So, Bill, how are you, given all those? I know it's a lot to consider, but given what do you know, how are you changing your business model, or if you are changing or adapting your business model to be able to serve this biggest volume of home buyers?
I think coming from an educational standpoint, like I do the first time home buyer webinars, those are very useful. I think there's just a lot of information that people don't understand. I mean, perfect example is mortgage insurance. So if you look at mortgage insurance could be, like I just met with a couple minutes ago, mortgage insurance could be as low as theirs, which is $39 a month for like a $275,000 loan, or it could be $200 depending on what their FICO scores are. The the market doesn't understand that. The first-time home buyer doesn't understand that. So you have to be able to educate them and put that out there. And it's just a matter of really just taking it and fine-tuning what your presentation is to these people. But I think the two things that people need to know when they buy a house is why,
Wait a minute.
Marcus
Six
said,
Flags in the theme park business. They're pretty big. Disney's in the theme park business. Disney's theme park business was doing very well. Six Flags was not as strong as people.
Who is that? Is that you, Bobby? Hello? Hello?
I lose my volume. I'm sorry.
Oh, something else came from it sounded like news.
Are you guys still here? Can you hear me?
Yeah. Yeah, I think it's just a matter of really just putting it,
My phone rang. I'm sorry.
Oh, is that it? Okay.
Can you guys hear me?
Yeah, I can hear you.
Yeah.
Can you hear us? Bobby?
Somehow I cannot hear you for some reason.
Oh, maybe it went over.
Can you guys keep talking?
Okay.
I'm pretty sure I'm going to edit this out. This is not good.
That's okay, Bobby. Happens to the best of us, right? Right, Marcus?
That's right. That's exactly.
So I was just saying that I think, one of the things that I always try to use simple kind of bullet point presentation style, like the two things reason why people want to buy, appreciation, amortization. There's how you build equity. Like you were saying, Marcus, is one of those things. It's not rocket science, but I think that people just don't understand. There's so much noise that's out there on the street level right now from the media, putting their own 2 cents in to everything else that's going on, that it just clouds the real truth of the matter. Why is homeownership good? And I think we'll see appreciation. The beauty of this market is that somebody right now can get a fair price in a house, not overpay like they were, and like you said, take advantage of a no cost refinance if that's what they're offering, and be able to lower that payment down the road and build more equity. So,
Yes, absolutely. I apologize. I lost my audio because someone called me. Hopefully you guys can hear me. But here's the very last slide, and we're towards the end. I apologize. We're running a little bit over here. But take a look at this particular slide from Case Shiller. It goes back to 1960, so had a recession early in the 60s. And of course, early 70s, I was old enough to remember. I was actually in the Philippines. I was in grade school, and we had a fuel crisis. And I remember long lines at the gas station. And I remember my mom taking a 100-gallon steel drum to purchase gasoline for our consumption. And come to find out, there was actually a hole in the drum and lost all that gasoline that she had purchased. But take a look at here in 2008, home prices actually dipped down, and the economy collapsed because of the recession. But the story in here is that home price index, i.e. home prices, have consistently gone up and trended up irrespective of the recession, and of course, with the exception of 2008. But 2020, during COVID, we did experience a recession, or we had a recession, but we really didn't experience it because it was so short-lived. But I believe right now we're in 2 quarters of GDP contraction. We're in a recession, but still, home prices will continue to go up. So, Marcus, how do you continue to tell this story to home buyers?
I think, man, this chart, Bobby, right here, I'm going to ask you to send this to me after we're done, because I think this really tells you a good portion of what you need to know about housing. Well, first of all, I tell people, and you mentioned this earlier, it's a core need of every human being on this planet, which is shelter. And technology can't, it can't be outsourced by technology. The three of us, if we said, hey, we're going to try to exist, even living in the suburbs without a vehicle today, 20 years ago, that wouldn't have been possible. Today, that's possible because I can just open my phone, call an Uber, whatever the case may be, or even, rent a car temporarily. Well, You can't do that with housing. One, if you look at that chart too, the only time that housing dipped through a recession was when housing was one of the main drivers for the recession, which was
Right.
08, 09. That's the reason it dipped, because it was really the impetus for it.
Right.
So out of that, that's why you don't want to time the market. You want to, there's a saying, you shouldn't wait to buy real estate. You should buy real estate and wait, because listen, the baby boomers, if you look at the homes they live in today, was a byproduct of the value of the real estate that they bought went back in the day and what they were able to sell it for. And by the way, my grandparents, I was really close to my maternal grandparents, and I was their second oldest child. So I got an inside look at a lot of things they did when they bought homes and stuff. My grandparents, when they bought their first home back in the late 70s, early 80s, you know what the interest rate was then?
17%.
Yep, you hit the nail right on the head. Yep, that's exactly right. And so I get it, but it's laughable today to hear people like the sky's falling over 5.5% and 6%. When I would have anybody who still is blessed enough to have your grandparents around, or depending on your parents' age, nice, Bobby.
I love it. Look at that. He's on point today, isn't he?
He is on top of it. Go talk to your grandparents or your parents and ask them what their interest rate was on their first home.
Yep, absolutely.
Yeah, I like that point. My brother had a rate card because he's been in the business way longer than I have, but he had it and he showed me those when he got in the business in the 80s, the same thing. They were in the teens. Yep. And I think what we're dealing with right now is that the hardest thing about change is change itself. So it's just a matter of things kind of marinating a little bit. I'm actually seeing a pickup in applications in the last month. I think people, because they're listening to guys like us that are going, look, guys, this is the way history repeats itself with regards to recession. So the beauty is that you can get into a house now and you don't have to overpay for it, and then take advantage of a refinance. I'm also seeing from the other side, just to kind of talk about Main Street level, like we were talking about, I'm getting a lot of people that currently own homes asking, okay, so how can I take advantage of my equity? You mentioned the investment. I had somebody call me recently asking to do investment. I go, no. They don't know anything about it. Don't take the money out of their investment property to buy an investment. Stick with what you know. And then the other thing too is I'm seeing that they either, like you mentioned, I don't have to get a car. A lot of people are working from home now. So they want that space. So they're asking, okay, what do I do with this space? Can I reno it? Yes, we have a renovation loan, but it may cost more to reno that property versus listing it, selling it, getting topped out, and moving into something that's already updated. So I'm getting a lot of people that are asking and bouncing questions off of me right now with regards to, should I stay or should I go? Like the old 90s song. I'm getting a lot of that. It's just amazing. So I feel like that the people, even if they had a 2.875 interest rate, like you said, what's their why? If they're going out of that space, 2.875 doesn't really mean a lot to them when they need more space to live, with each other, Yep. So.
Yep.
And Bill brought up a great point, which is, with the world changing, what we talk about on our team is that we have to tell the story to our clients or else someone else will. And so, Bobby, you mentioned, information at our fingertips. Well, I think that's both a pro and a con, because there's so much information out there today. So I think it's almost like eating from a buffet and trying to eat consume everything there. We all know as guys how that goes, how that turns out. You try to eat everything on a buffet.
Not a good thing. Mm-hmm.
No, not a good thing. Versus, hey, okay, what really makes sense for me? So what I'm telling people when I say on my social media repeatedly, don't just read the headline before click on it, because headlines are designed to get you to react.
Right.
Click on it, read at least half of the story, because I can't tell you how many times I'll see a headline, and then once I read the story, even on YouTube, I'll see a headline and then I listen to it, and they're not their overall thesis is not what the headline said. And so, just to make sure you educate yourself. And here's the other thing. The world has changed since 08, 09. There's some real estate that's never going to come back on the market, at least for a considerable amount of time. Because if you look at institutionalized investors like Wall Street, hedge funds,
right.
own a significant amount of real estate compared to 2 decades ago because they know the long-term value of it.
Right.
Invest in things that they feel like is going to have a great rate of return long-term. 2, around, probably not coincidentally, around 08, 09, Airbnb was created. Well, those properties won't be coming back on the market, at least not at any significant rate, because you have homeowners who may own 2 and 3 properties. And if those things are generating cash for them, when are they ever going to sell those properties?
Right. Great points. I like that. Yeah. I mean, because right now as an investor, I'm an investor and Bobby is too. And I mean, it's one of those things where Bobby's doing the Airbnb. I took more long-term approach, watching grass grow with a rental. But the 2 reasons why you buy investment properties, either cash flow, which is Airbnb, or you build appreciation. Yeah. And I think you're right. Nobody's going to sell a property if they're getting nice cash flow right now.
Especially if they locked it in at a rate that has a 2 or a 3 in front of it.
Yep. Good point.
Yep, absolutely. Hey, great conversations today. I wish we could run 2 more hours, but of course, we cannot do that. My name is Bobby Taruc. This will be on our social media channels. My phone number, call or text us, 773-372-7564. Keywords Team Taruc on all social media channels. And Marcus, how do people get a hold of you?
Sure. So on most social media channels, you can find us one of 2 ways: Property Pro 74 or at Rembert Blount Property Group, and number is 815-793-5736. And we have these discussions on our social media channels all the time. So
absolutely. Awesome. Bill, how do people get a hold of you?
So mine is Bill the Mortgage Guy. That's my user profile on social media. So I'm on Instagram, LinkedIn, and also Facebook. And then my cell phone number is 630-330-LOAN. Pick that out back in the early days.
Nice.
Okay, thank you so much.
It's been a pleasure, guys. Seriously, it's been nice talking to you.
Yeah, same here. Enjoyed it.
Absolutely. Hopefully this is not the last time we're going to do this. And everyone have a great day today and have a great week. Thank you.
All right.